I think you are going to see emergence of few wonderful companies and wonderful investment opportunities in next 4-5 years. So what are the characteristics of this market? How do we make money? What are the challenges? And what are the few questions which come from most of the people? So let's see, investing is foregoing consumption now in order to get more purchasing power in the future. I mean, it is inflation adjusted kind of a situation where you give 100 rupees today to get more inflation adjusted in next 5, 10, 15 years. So this is a definition which is very new definition. Earlier it used to be give money, today's money to get more in the future. But no, it has to be inflation adjusted. So first big enemy in India is inflation. Next. Yeah. So because of, go back. Yeah. So the fundamental investment risk is not losing one's money, but out. Because of inflation, you might live longer than, because the health conditions are improving, you might live longer than your money. And money will get finished or lose the value because of inflation. Next. So what is the history of inflation? This is a 34-year history of inflation. 8.5% compounded for 34 years. This is the RBI audited data, CPI. So inflation is not a new story. We are having it for last, I think, the whole century. So we are going to have elevated inflation. Maybe, I mean, Lord Desai can probably explain, but this is not a new phenomenon. And in last 34 years, 100 rupees has become 6 rupees, 1/15th. Next. So how the asset classes have done? Look at the fixed income, that is the red line. 100 has become 1500, so 1 has become 15. Gold has become 45, 48. And stocks have become 25,000, means 250 times. And come dividend, hold your breath, it's about 40,000. So it is full 400 times. And I am not talking about outperformance, because in gold, in fixed income, you cannot outperform. In fixed income, from 8.1%, a person who gets gold medal, he gives 8.15%. But in equities, when index is doing 17%, you can do comfortably about 20%, 22%. And the masters like Rakesh Jhunjhunwala, Ramesh Damani, RKD, they must be doing more like 30, 32%. So, equity is the way to go about in making money. Next. So how does it work in inflation adjusted environment? 100 remains 100. Fixed income world over doesn't create wealth. It is inflation adjusting mechanism. Whether you go in America, whether you go in Europe, whether you go in Japan, India, your inflation rate will decide your rate of inflation. Inflation is post-tax, rate of return in the fixed income is pre-tax. And now government has made it sure that it is a pre-tax. So all the FMPs and all where you used to get 9-10%, it's all gone. Probably he saw the presentation and he said, I'll make sure that it is pre-tax. So that is gone. Now you have to equate, but inflation, he keeps it still post-tax, So you have a big problem, how do you beat the inflation? Next. Yeah. So people ask, why to invest now? I mean, market has gone up so much from 6,000 to 7,000, 7,500. Next. So I think the real challenge now is that you might miss out 25%. I mean, what people are, I'm not afraid of, somebody says, these are all quotations of some wise guys somewhere in the world. I am not afraid of being the next 25% down take. I am afraid of missing the next 100% take. One cannot time the market. Right now, if you are trying to figure out whether we should buy at 7,200 or 7,300 or 7,400, 16th May, even Modi was not knowing that it is going to be 272 plus BJP. So very unlikely that market is going to go below 272. Very unlikely in normal circumstances. So you are left with 300-400 points gap. Whether it goes to touch that or not, I don't have any clue. But if you keep sweating about 3-4%, 5%, even 10% downside, and then I'll buy, then you might be missing on, and by chance if that correction doesn't come, and particularly in the stock which you want to buy, if that correction doesn't come, then you are missing hundreds and thousands of % of gain in the entire investing process. Yeah. So I think, no, this is better, I think. When you look at this. Yeah. Okay. So the, the downside, the fear of downside, the moment I buy, I'm going to lose 10% or 5%, which has been the experience of most of the people. Not only you, but me also. Whenever I buy, always it goes down by 5, 6%. But I don't stop buying. I keep it pushing. I keep it pushing. I buy very aggressively in the beginning. If something I start buying at 145, I'll keep buying at 150, 155, 157, be done with. The moment I stop, it goes down to again 145. I'm happy. Because the point is, if you keep bothering about this, because I'm not buying for next 1 month, 2 months, or 5 months, and I'm going to sell at 200 rupees. I'm buying for at least 10 times, or 20 times, 30 times. And actually, what happens is that it delivers that. I bought one stock last year, this Gujarat Pipao, at about 45 rupees. And Rakesh knows that. I kept on buying, and at that level, when you buy, what happens is you want to buy 5 lakhs, you get offer for 50 lakhs because everybody wants to get out. I said, what is wrong? Then, then I said, okay, I want to buy only 2 lakhs or 3 lakhs or 5 lakhs. Then we bought whatever quantity we wanted to buy. And then stock very promptly, I bought till 55, it came down to 48, 49. Then the first result came. Straight it opened 55. Then the second result came after 3 months. It went to 70, 72. Third result came in December, in March. Again, it went to 110, 120. Now the entire infrastructure story, port, export boom, everything is starting. Today it was up to about 130, 132 or something like that. I was in America and he sent me SMS that stock has crossed 100. So, but I don't bother, but I mean, I've done it. It's packed, boxed, everything. I bought it for 10 years. It is going to be lying there. If the story turns out right, it's very good. If it doesn't turn out, in that case, we'll move on, buy something else. So what I'm saying is, don't be worried about 2, 3, 4%, 5% correction. If you like the stock, if it is a long-term bet, please go ahead and complete that. Next. Quality versus valuation. I always say that 90, 95% of the problem comes because of the low quality of stock coming into our portfolios because they are cheap. In equities, you get cheapness by the low P multiple. In debts, you get cheapness by higher yield. 25%, 30%, 35%, कोई न कोई परसेंटेज में पैसा दे देते हैं आप वो पैसा वापस आना ही नहीं है same in equities. The moment you buy a 2, 3 P multiple or 4 P multiple, a bad company which you don't understand, mostly that is a permanent investment in your portfolio. Never you'll get anything. So always stick to the quality. Always stick to the quality. And if you can get very high quality, very cheap, of course, you must sell everything and buy equity only. But this is the 4 quadrant of high quality, low valuation, high valuation. The deep green is the place where you must back up the truck and buy as much as you can buy. Don't bother about timing anything. If you ever get anything cheap and very high quality, huh? I don't have any. The last year I bought one was this GPPL, which was wonderful quality. Top quality port and run by a Danish company, APM Terminals, and available at about 10, 12 P multiple. It was like dream come true. So one stock which comes to my mind, which is very new, but it is not that cheap, but very high quality business, high quality management, very long term. Not very cheap, somewhere in between, buy right, sit tight. It's the United Spirits. United Spirits, they don't take much profit, but I think long term is going to be, this country has just started to drink. So, with Modi Saab, though he doesn't drink, but I think he's creating an environment for much more drinking sessions. So I think quality high. Now, when the quality is low, now the problem is when the quality is low and valuations are low, which was when the index was 5,000. At that point, it is a perfect thing to do, buy low quality at low price. The problem is, it comes into home, low quality, it quickly rises 3, 4 times, but you don't know when it has crossed from low price, low valuation to this danger zone, the red one, deep red. This is a suicide point in investing. When you buy low quality at high price, and you don't know when it has become high priced. So that's why I said I don't want to get into this low quality zone at all. Because I have suffered enough. I mean, in 35 years, I have suffered maximum because of this particular quadrant. Low quality is somehow coming into the portfolio. They'll always give you pain. More pain than, I mean, sometimes you'll make money, get out, but most of the time, you'll be stuck and you'll lose money. On the whole, you'll lose. So that's my experience. So we try to buy, and buy right means buy high quality and at reasonable price. Next. Another thing is, in high quality stocks, downs are temporary, ups are permanent. Think about it, what I'm saying. If you look at the index as a whole, BSE index, yes, it goes up, it goes down, it takes sometimes 1 year, it takes 2 years to get to the new high. I mean, in Harshad Bhai took it to 4,500 and it took 10 years for it to go to the next new high. So that was a 65p multiple and those kind of things, exorbitant. So it took some time, but most of the time, you'll find that in 2007, it went to 21,000, it came down to 8,000, and again it went to 21,000 within no time. So, and in stocks, high quality stocks, HDFC Bank, HDFC, TCS, they go down for 6, 7 months, and again they hit the new high. So downs are temporary. You see the example, TCS, Infosys, next. In index, it is much better explained. But the low quality, the concept is just the opposite. Downs are permanent, ups are temporary. You decide what you want to buy. These stocks which have gone 3, 4 times from 10 rupees to 20, 30 rupees, they are very temporary, those levels. They will crash and again they will show their color to come back to 7 rupees. It is guaranteed because they don't make money. They are broken business models. Nobody can hold them up. And when a good company goes down, you cannot hold them down because they're making every day bigger and bigger amount of money. Next. So how much should I invest? You know, I mean, most of the people are very rich in India. They're so rich that they themselves don't know how much money they have. The rich people, they have so much of money, they don't know. And they are not investing enough in equities. That's why we need foreign support. Otherwise, this country doesn't need $10, $20 billion from foreigners. In a $2 trillion economy with 30% savings rate, I think $100, $200 billion is like a breakfast money. But we don't get it. We will get it. At 50,000 index, you see how much money will come. You just watch this. It just happens. You get 1% of GDP in 1 year. In 2008, at the peak, when they should not be buying a stock, they bought 52,000 crores. That is more than 1% of GDP. Now GDP is 120 lakh crores. In 2 years' time, whenever foreign Indians will come, they will come with 150,000 crores in 1 year. And we'll be here. You just watch it. It's not going to be very far away. It's only 24 to 36 months. And Modi Sahab has made it faster. Next. So, you know, how people allocate. This is how people allocate. They start little. If they have 10 crores, they'll start with 25 lakhs. They'll always ask me, Raamdeo, how much should I start with? I mean, what is the lowest you take? I said, boss, you're so big a guy. Whatever you send, it is good enough. But SEBI says 25 lakhs. So next day morning, you find 50 lakhs or 1 crore check out lying there. I said, boss, this is crazy. I spent 2 hours with a 100 crore guy and I got a crore. It was not worth my time. But that's how he starts. Anyway, so this is how they start. The way to start is next. This is how they should start. When index is at 7,000, you should invest like this, like a simple pyramid. Maximum allocation at the beginning and least at the top. People, what they do, and that's why they don't ever make money. They start small and they keep, as the index keeps rising in cyclical economy, they invest highest at the top. The average is actually lower than the middle. So when the market crashes, it goes right below their average purchase price. So actually they don't make any money. They're there in the market for 5 years, but they actually end up making losses. And that bad experience, again they start the same thing next time. They say, I'm very unlucky in the market. You meet so many people, they say, I'm very unlucky in the market. But what you did, you try to realize. So, you know, one of the problem is how do you allocate? Next. You see, this is the thing which I was saying. Investors timing go wrong. Whenever people come to me, all the real estate guys, they are saying, sir, I've got 5,000 crores worth of land, 500 crores of land, and how should I start and all. So, and I don't like equities because real estate is very good. I said, very good. Why are you wasting your time as well as mine? Because he's feeling very bad because his neighbor is making money in stocks now. He's not making money in real estate, but his neighbor is making money in stocks. So he's examining. I said, if you don't want to sell your real estate portfolio or you don't want to allocate in stocks, very good. You love that product, you keep away. But don't come at 50,000. Don't start liking equities at 50,000. This is what really happens. People change their view at higher prices. The portfolio. The person is saying, this is one of the most best financial planner US ever had. This guy says, before the retirement it should be 100% and make sure after retirement also it is 100%. Because, you see, the point is you have to beat the inflation. The retired guy needs the equity money more than anybody else. You and me who are earning, probably we can, we don't need that much on your portfolio. But the person who is retiring, he must see that money lasts him longer than he lives. Next. So I think there are a few thoughts on investing, which I'm also learning from these quotes. And this was a wonderful opportunity to speak before you. But as far as the market outlook is concerned, my sense is, as I said, this is a rare opportunity. People ask me, when did you become bull in this market? I said, I started the business 27 years back. So for 27 years, we are doing bull market only. For us, India has been 27 years bull market. I think next 27 years also will be even bigger bull market. Now the issue is, do you want to time this 5-10% of the downside? If at all there is one. I don't know whether it is there or not. But if you want to time that, it is all the best to you. And better you get the bottom of the market and sell that at the top of the market. But that's a fool's paradise in the sense that these tops and bottoms are made for fools and liars. The guy who says that I bought it exactly at bottom of the market and now I sold it at 7,700 or 7,800. I think those guys, they're actually not seen what is the market. So my experience is buy high quality companies, buy as much as you can afford to buy and not be bothered about it and just stay on. And another thing is that if you can't do it yourself, please hire a manager. And India has wonderful managers who will take care of your money for 1.5%, buy the products, buy the stocks, and I think you'll do very well. This country is set to make a lot of money through the stock market. This is the time to encash on it. Thank you very much.